Today we are going to talk about some of the amendments that we've made to some of our asset-related standards, and probably one of the key things you will be asking is why exactly did we decide to make these amendments? These standards have been issued and in place for some time. Well, quite frankly, the reason why we decided to change them is that we had heard feedback from some of our constituents that we needed to make some changes. There were some aspects that were quite onerous to apply in practice. So what we decided to do is the board can't just make changes to standards without having a good understanding of whether or not the information that is currently being produced is actually relevant to users' needs. So the board decided to undertake a post-implementation review of GRAP 16 on investment property and GRAP 17 on property, plant and equipment. What really we tried to do with the post-implementation review was to identify from a user's point of view if the information that's being produced in the financial statements at the moment actually meet users' needs. It helps them to hold entities accountable and make decisions. And likewise, from a preparer point of view, to really identify those key issues that preparers do still struggle with in practice and obviously come up with suitable ways to deal with them, obviously without making sure we don't lose any of the information that users already want. So based on the feedback that we got as part of this post-implementation review process, we decided to make changes to both GRAP 16 and GRAP 17, and there's a couple of consequential changes across some of the other asset-related standards as a consequence of that. So what I'm really going to talk to you about today is some of the key changes that we had made. These are effective from 1 April 2016. So the effect of that is that for PFMA entities, they would need to comply with these requirements for their 31 March 2017 year end. And for MFMA entities, it would be 30 June 2017. So it's this reporting cycle that we are in at the moment. Just to give you a high-level overview of 6 of the key changes that we decided to make, and some of them were prompted either by users' requirements or by preparers indicating that they needed to make certain changes to make it easier to apply the standards. The first one was a distinction between investment property and property, plant and equipment, and this is particularly in relation to the classification of land and buildings, and obviously this was a key issue that has been experienced in practice and has given rise to a number of audit qualifications in particular. The second aspect that I'm going to have a look at is the reassessment of useful lives and residual values. Again, very challenging for those entities that have large pieces of infrastructure, as well as land and buildings. The third issue is having a look at the use of external valuers, and in particular whether or not it is a requirement of the standard to use external valuers to value property in particular, or whether or not you could use another expert to do this for you. The next one is disclosure on capital work in progress, and this was really a change that was prompted from users' needs. They had indicated to us that there just is an insufficient level of disclosure at the moment on capital work in progress, and it's not really helping them to hold entities accountable and to make decisions. The second last one that I'm going to deal with is the deletion of certain encouraged disclosures in the standard, and this was prompted by preparers telling us, well, we could probably do a bit to clean up the standards just to make them a bit more user-friendly, and if requirements are not required in the standard, why even do we encourage them? So we can just delete them. And the last one is additional disclosure on repairs and maintenance that entities have spent on their assets and on their key pieces of infrastructure. And again, this was prompted by users' requirements to say, well, there just isn't sufficient disclosure in the financial statements at the moment about these things. So with that, I'm going to move on to the first amendment, which is really the classification between investment property and property, plants and equipment. Now, with all of these, I think it's really important just to understand what the existing requirement was, what kind of caused the issues that we needed to deal with, and then obviously where we landed in terms of the amendments. So if we're having a look at investment property in particular, the definition of investment property is that it's land or buildings held for capital appreciation or for rental to third parties. From a property, plant and equipment point of view, it could be land and buildings, but a whole lot of other assets, but what we're focusing on here is land and buildings, and that they would obviously be used in the production or supply of goods or services for administrative purposes or held for sale in the ordinary course of operations. So obviously we need to have a look at those two definitions in understanding whether something is investment property or property, plant and equipment. Sorry, a key part of the GRAP 17 definition of property, plant and equipment is also rental to third parties. So as you can see, there's a clear overlap between, on the one hand, investment property, land and buildings being rental to third parties, And likewise on property, plant and equipment side being rental to third parties as well. So this is really the overlap that caused some difficulty in practice, because preparers told us, well, if I can rent out both land and buildings under both of these standards, when do I classify land and buildings as either investment property or property, plant and equipment? So what we really did is have a look at the existing requirements in the standards. We actually didn't amend anything fundamental. We just had a look at the existing requirements, and we tried to pick out what were some of the key questions and challenges that were being posed to us. So what we've actually done is clarified quite clearly that if you use assets in the production or supply of goods and services, they would always be classified as property, plant and equipment, because they meet your primary mandate, the primary reason why these entities actually exist, and therefore should be classified as property, plant and equipment. So if you're thinking particularly from let's say a municipality's point of view, they would often have land and other sorts of property that they might rent out for a fee or in terms of a lease or whatever the requirement might be, but they do these to achieve their specific mandate. And in particular, what I'm thinking about is housing arrangements. That's a very good example, social housing in particular. Could also be recreational facilities that entities rent out, community assets. It really is land or buildings that is being used in an entity's service delivery as part of its key mandate. So if we have a look at achieving how is it that we understand whether or not this is part of an entity's mandate, well, you would really go back to the basic legislation and regulations in place. It could be things like the Constitution that outlines this particular information, the schedules in the Constitution in particular, the Municipal Systems and Structures Act, or there could be municipal bylaws or other arrangements in place that you would have a look at. So that would really be the key focus. Do I have this land or buildings or whatever it is to produce goods and services in terms of my ordinary course of operations? And if that is the case, then I would classify it as PP&E automatically. If it isn't clear from looking at your mandate and the specific legislation and regulations governing that, whether or not you holding these land or buildings to fulfill that objective, well, then you would need to go and have a look at why it is that you are renting these properties out and exactly what is the nature of the fee that you are receiving. And you would really need to assess two things. So, am I receiving a fee just for the rental of the property, or am I receiving a fee actually because this asset is being used in conjunction with other assets to provide a service? So if, using an example, if it's very clear that you are just receiving a fee for the rental of the property on its own, it could just be a house or a piece of land that you might rent out for grazing. Quite clearly it could be investment property then. But if you are using it with other assets, let's say it's a sports facility that you are renting out, obviously it's clear you're using your property plus a whole lot of other assets to provide a particular service, and then it could be that the fee is for use of a sporting facility rather than just the rental of a property, and then the nature of the fee that you are receiving is actually for a service, so it should be property, plant and equipment rather than investment property. The last thing to have a look at is whether or not you hold these properties in the sale of ordinary course of operations. And if that is the case, well, then you're going to classify them as inventory rather than as property, plant and equipment or investment property. This would typically be the case if you are an entity that is involved in acquiring land and disposing of it quite soon or transferring it to another organization. A land redistribution program is a very good example, and it could also be for some departments, entities or municipalities that are involved in housing arrangements. So just to recap the three things, firstly you need to assess whether or not the properties are being used in the production or supply of goods and services as outlined in your mandate. If yes, always going to be property, plant and equipment. Second aspect, having a look if it isn't clear from your mandate that you should be holding these properties to generate service potential or economic benefits through the goods and services you provide, then you need to have a look at the nature of the fee and what it is you are receiving it for. Is it just for the rental of the property, or are you receiving some sort of a service from the entity by actually using it in conjunction with other assets? Thirdly, if it's held for sale or transfer in the ordinary course of operations, then it's going to be inventory rather than PP&E or investment property. And one other thing that I just want to touch on, it was a requirement already in the existing standard of GRAP on investment property. It always dealt with something called land held for a strategic purpose. And the requirement was in GRAP 16 is that if you held land for an undetermined future use, it would always be classified as investment property. What we are saying is that if you are holding land for a strategic purpose, obviously you would need to have a look at the entity's plans and processes in place to deal with these specific properties. But obviously, if it's very clear that you're going to use these properties to deliver services and goods in the future, then obviously you would classify it as land held for a strategic purpose, and it would be classified as property, plants and equipment rather than investment property. So I think, although it was in the previous version of the standard, I think it's a lot clearer now that if it's held for a strategic purpose, it will be PP&E if obviously your intention is to use it as part of your service delivery objectives. The next change that I'm going to take you through is, again, just a couple of requirements or clarifications, at least, on investment property. So that dealt quite clearly with the classification of certain items or certain items of land and buildings between PP&E and investment property. There were a couple of other issues that kept recurring when we did our consultation as part of the post-implementation review. And there's three particular things that I just want to touch on. I think the one thing that kept coming up was this question about, well, if I'm charging a market-related rental, should I then always classify land or buildings as investment property rather than property, plants and equipment? And it isn't important the quantum of revenue that you get, it's really important what you use the land and buildings for. Again, going back to that idea of if it's linked to service delivery, then in terms of your mandate, it's always going to be PP&E, even if it is a market-related rental that you are charging. The second thing that I just want to talk about is the existence of a lease. I think somehow there's always this question about, well, if there's a lease, then it's always going to be classified as an investment property. That's not the case. If we go back to the basic definition again of property, plants and equipment, again, you can have PP&E that's classified as held for rental to others. So quite clearly you can have a lease both in terms of classification as PP&E or as investment property. The last thing that I want to touch on is, again, this idea of a market-related rental or a commercial kind of objective. Again, you can have property that's classified as investment property even though you're not charging a market-related rent, and it could be for certain social reasons or economic reasons that you do that. If you think about some of the regeneration that's being done in the inner city of Johannesburg, Cape Town, Pretoria, all of those areas, might be that particularly municipalities and property companies would not be able to charge a market-related rental in those areas because obviously they're trying to achieve different objectives to stimulate economic growth, etc. So again, I can't emphasize enough that you really don't just focus on the quantum of revenue that you get or that it's market-related or commercially related in any way. You really have a look at the underlying use of the land and buildings when you classify as investment property or property, plants and equipment. The next thing that I want to go on is probably one of the biggest changes that we made as part of this raft of changes to GRAP 16 and GRAP 17, and it really deals with the reassessment of useful lives and residual values. Looking at the old requirement read the residual value and useful life shall be reviewed at every reporting date. Now obviously there was some misconception that you needed to go and have a look at every asset at every reporting date and do some sort of calculation to assess whether or not the useful life and residual value had changed. That was never the requirement, so that was one of the first things that we needed to assess is how do we correct this behavior. The second thing that we needed to correct is there was this idea that you needed to go and do a condition assessment of each of your assets again at every reporting date. Condition assessments are usually driven from an asset management point of view and would generally only be done for the riskier assets on a very frequent basis and sort of on a rotational kind of basis for some of the other assets. So we had this idea that financial statement reporting was in somehow actually driving asset management, but instead the asset management and what you are doing should actually have just been reflected in the financial statements as one of your key pieces of evidence. So what we did is when we consulted with preparers, quite clearly they had indicated to us that the requirement is too onerous, in part because I think of the way it had been implemented, but we really asked, so what is it that we could do to make it easier for you? Now you would know in our impairment standards, you're not required to go and test for impairment every year. What you need to do is assess whether or not there's any indication that an asset has been impaired. And if that is the case, then obviously you would then go and do more detailed testing and more detailed calculations. So what people indicated to us is that system works quite well, so why not introduce the same approach when we are having a look at whether or not we need to reassess the useful lives and residual values of assets. So we did that. We consulted engineers and asset management managers who were quite involved in both an asset management point of view and from a financial reporting point of view, and came up with what we thought was a suitable list of indicators to include in GRAP 17. So the new requirement is that you will assess at every reporting date whether there is any indication that the useful life or residual value has changed from the previous reporting period. So again, you go and assess whether or not you've triggered any of these indicators, and if that is the case, then you would go and do more detailed testing. Just to give you an idea of some of the indicators is firstly, that the composition of the asset has changed. I think if you think about roads as an example, you would generally componentize that into the top layer, the second layer, and then obviously the base layers. If for some reason you've had to change any of those or change the specific materials that you've used, then obviously there may be an indication that the useful lives of those various components have changed and that you would need to reassess them. The other key thing is, I think, to assess from an indicator point of view is whether or not the way in which you have used the asset has changed since the last reporting period. And we've tried to put together a fairly comprehensive list, but obviously you would need to assess whether there are any more, is really whether the manner in which you have used an asset has changed. And an example I always like to use is you might have a vehicle that you use. You might be using it currently to sort of deliver documents or whatever it might be from an administrative point of view in the city. If you're going to take it off-site and start using it in a construction kind of space, then obviously you would need to reassess whether or not you are actually going to be able to use that vehicle for the same period of time. The second one is the utilization rate. And this is particularly relevant if you're having a look at infrastructure type assets, and you would find it quite commonly with new developments where infrastructure is put in place, it has a specific capacity. Obviously when people initially move into that area, the utilization rate of the asset is quite low, but obviously as it becomes more populated, the utilization rate would increase. So potentially there could be a change in the useful life of the asset if it is utilized more or less than it anticipated. Another thing that could trigger an indication that you need to reassess the useful life and residual value is a decision to sell an asset either before or later than anticipated. So typically it could be a capital asset program that you have going, that you want to sell your assets within 2 years. If obviously you need to change that because of budget constraints as an example, and you're going to sell it within 5 years, obviously you would need to adjust the useful life and you would also need to adjust the residual value accordingly. There might be technological, environmental, or other changes that you would need to consider, and one of the key things here is some sort of material that you might not be able to use anymore, either because it isn't environmentally friendly or just from a technological point of view it isn't feasible to continue to use that going forward. One that you might find fairly infrequently but might be relevant for things like landfill sites is having a look at legal or other limits that might be associated with the use of the asset. Quite frequently in these types of situations you would have a specific license that is granted for a period of time with certain conditions attached. Obviously if you're not fulfilling those conditions, they might reduce the period over which you could use that license, or there may be other reasons. The other one is having a look at whether or not the asset has been idle during the year or retired from use, and obviously that would again affect the period over which you use the asset. A couple of more practical ones is, I think one of the things that the engineers highlighted to us is one of the easiest ways to assess whether or not you need to assess the useful lives and residual values is really just having a look at the asset register and assessing all of those assets that are reaching the end of their useful life, and obviously going to have a look at those specifically and say, well, how long am I actually going to use these for, what are my plans, etc. So that's just a very practical way, and it's quite easy for most systems to actually generate this kind of information. Having a look at your planned repairs and maintenance and any sort of refurbishments that you want to do during the year. Obviously, if you are not repairing and maintaining your assets as expected, they're never going to get to their complete useful life when they were designed and specified. So again, you would need to go and adjust it. Likewise, if you've been very diligent in doing all your repairs and maintenances and refurbishments, obviously it's possible that you could increase the useful life to some extent. It would be important to also have a look at environmental factors. So one of the key things is water is often not very good for infrastructure assets, particularly if it's related to roads and other sorts of infrastructure like that. So for example, if it's been raining quite heavily, you would know that you have potholes, you have portions of the road that might wash away. Likewise, there might be other circumstances where sun, hail, etc., would also not be very good for assets. So just considering generally the climate and what the year has been like, and having a look at whether or not that has an impact on the useful lives of assets. The last one and most important one is, and I touched on it when I started off, is to say, well, one of the key things that we heard initially was that there seemed to be this requirement to go and do a condition assessment at every reporting period for each asset. We've made it quite clear now that having information from a condition assessment is just really one of the things that you would assess, so one of the indicators to assess whether or not there has been a change in useful life or residual value, but it's not a requirement that you go and do it every year. As I mentioned, condition assessments generally done from an asset management point of view based on a risk kind of matrix. The riskier assets, you would do it more frequently. For the less risky ones, it would be fairly infrequent and probably on an ad hoc or rotational basis. Where you do these assessments and there is any indication that there has been a change in how long the asset is going to be used, then obviously you would use that information to actually go and do more detailed testing. The other thing that I just want to touch on in terms of, we've spoken now quite a lot about the useful lives, the same indicators and the same approach would equally apply to residual values, and there would obviously sometimes be a direct correlation between the two. So particularly for those types of assets where you plan to dispose of them at the end of their useful life, if we change the useful life, you would obviously need to change the residual value as well. Okay. The next change that I want to talk to you about is the use of external valuers. Now, one of the things that we heard quite a lot when we went to go and talk to preparers is that there was this idea and misconception, and I think it may have been some sort of disagreement between auditors and auditees about the use of external valuers to value property. So the requirement in the standard, as before we started off the process, was that appraisal is normally undertaken by a member of the valuation profession who holds a recognized and relevant qualification. So we didn't say that you have to always use an independent expert. We said normally these types of assets you would use an external person, but it was never a requirement. So what we had heard quite a lot, particularly from municipalities, is that if they do have very large property sections, particularly when you want to value properties for municipal tariff setting purposes, they do have their own set of internal experts, and they are very competent in valuing property, particularly in that particular area. So what we did is we revised the wording slightly to say that the valuation and appraisal may be undertaken by a member of the valuation profession who holds a recognized and relevant qualification, but it can also be an internal person or another competent expert, and the requirement is really just that these people are competent to be able to do the valuations as required by our particular standards. So it's not necessary that they are a member of an external body, but what they really need to demonstrate is their competence and expertise in carrying out valuations in accordance with standards of GRAP for financial reporting purposes. The other thing that we decided to change is there was previously a disclosure requirement to indicate whether or not you had used an external person. Well, because we're changing the requirement to say now, well, it can be an external person or an internal person, we've decided to delete that particular disclosure requirement. This is one of the changes that we've made that has an impact on some of the other asset-related standards. So importantly, this change would now be reflected in both GRAP 16 on investment property, GRAP 17 property, plants and equipment, and GRAP 103 on heritage assets. The next change is about disclosure of capital work in progress, and as I mentioned, this is actually one of the requirements that users indicated to us. There is insufficient disclosure at the moment in the financial statements on capital work in progress. The current requirement or the previous requirement was that there's a specific category that you would show as assets under construction, and really any work in progress that you had of a capital nature was just reflected in that particular asset category. When we spoke to users, they sort of had two concerns. The one was they had no idea of the underlying nature of the capital work in progress because it was just one number. They didn't know if it was for administrative buildings, they didn't know if it was for infrastructure, they didn't know if it was for housing, they had no idea what it was for. So that was a real concern. They really wanted more information about what is the nature of the capital work in progress. And the second concern that they had expressed some reservation about was that the number just seems to get bigger every year. So without knowing why the number is just getting bigger and not getting smaller. They wanted additional information about what is sitting in that number. So what we have done to address the concern raised by users that there isn't sufficient information about the nature of the assets in the capital work in progress is that you are actually going to disclose the cumulative expenditure capitalized per class of asset. So again, this would depend on the classification of the entity, but if it's for buildings, you would have now a separate category indicating what is work in progress for buildings. If it's for infrastructure, and you obviously may have this broken down into further components, you would again just indicate what actually is the spend that's still in progress. Now the next two, we've had quite a bit of resistance, I guess, from a preparer point of view in terms of disclosure, but again, it's going to be really helpful for users. So I think we need to find the balance in terms of users' information needs and obviously the cost of preparing this information. And I think once you start preparing it, it will be quite easy for you to disclose it. The first one is the construction of assets that are taking a significantly longer period of time to complete than expected. So what we had initially heard from preparers during the consultation on these changes was, okay, so now you're going to require me to present an aging of my capital work in progress in the notes to the financial statements, and that's not the requirement. So what we really want you to do is have a look at those particular, and it can be projects, depending on how you classify them, that are really taking a lot longer than the initial plan. For completion, and obviously you would disclose some information about that. So let's say the project was meant to be finished in 5 years and you are already sitting on year number 5, 6, 7, 8. Obviously that number, those costs are not getting cleared out of the capital work in progress, so quite clearly users are going to need some information about what is going on with those particular projects. The last one is construction of assets that has stopped or halted, and the reason for stopping or halting the construction related to those assets, and then obviously providing some information about whether or not those assets have been impaired. One of the things that we come across quite often is, from the one end, is it might be that there are land claims related to certain projects that are going on, and we know that those get halted and stopped, and obviously you would need to then assess whether or not there's a possibility of continuing with those projects or if they need to be stopped. And another thing that we see happen quite often is actually that there's insufficient budget available, and then the construction kind of stops and then that asset goes nowhere. And I think those are the types of things where users really want information to understand what it is that they need to do to progress these projects or stop them completely. Now, I think the one thing that made it a little bit uncomfortable from a preparer point of view is to say, well, how am I going to present this information? It seems like quite a lot that I might need to disclose, particularly if I'm a municipality, as an example. But I think what we have said is, because this is a new requirement, we'll obviously need to monitor the type of information that is provided and assess whether it is meeting users' needs. But obviously there's flexibility in terms of the level of detail that you provide. So you can, if you want to provide some information on specific projects, you might want to aggregate some other information in a certain way, but it is really up to you in terms of how you present this information in the notes to the financial statements, and really what makes sense from your business point of view. Again, I just want to highlight that although we discussed these changes in the context of GRAP 17 in particular, the same changes we have made to GRAP 31 on intangible assets and GRAP 103 on heritage assets. The other thing we did as part of our post-implementation review amendments is really to have a look at the existing asset-related standards, so GRAP 16, 17, 31 and 103. 31 is on intangible assets. Really just have a look at some of the encouraged disclosures that we had in the financial statements. What we had heard from preparers is that it's often difficult for them to decide whether or not they need to provide this information, and usually just results in disagreements with auditors during the audit space. So we went through the disclosures and decided to eliminate a number of them, and obviously going forward I think it's part of the board's strategy to either require disclosure or leave it out of the standard. Having encouraged disclosures isn't really helpful. So in terms of GRAP 17, what's been eliminated is property, plant and equipment not utilised during the reporting period. I think when we were having a look at this again, a lot of preparers raised concerns about, well, how long is not utilised? Is it at reporting date? Do I need to keep track of everything during the reporting period? So they were unsure of what they needed to do, and they were also unsure of what really the informational value was. The carrying amount of fully depreciated assets, I think this had caused quite a lot of confusion with the requirement that you actually need to, if you have fully depreciated assets, obviously assess whether or not you had applied all the requirements correctly in the past, and if you hadn't, actually gone back and adjusted appropriately, or obviously you would need to write back some of the depreciation if you had applied the requirements correctly to make sure that there is still a portion of the assets available to be used. The other one was the carrying value of assets that had been retired but not classified as a discontinued operation. And the last one was the fair value of property, plant and equipment when the cost model was used. Now, obviously, there's quite a lot of controversy, I guess, about whether or not we should use historical cost or a revaluation model for PP&E, particularly when it comes to infrastructure. But I think by and large, it's easier for entities to apply the cost model, and it's obviously the most cost efficient at this point in time. So actually asking entities to provide the fair value of assets when they use the cost model isn't really feasible. The change that we made to GRAP 17 is exactly that as well. There was also an encouraged disclosure to disclose the fair value of investment property where you use the cost model. Again, we decided to delete that for the same reasons for property, plants and equipment. For GRAP 31, again deleted the requirement for fully depreciated or fully amortized intangible assets that were still being used. Again, for the same reasons for GRAP 17 and fully depreciated PP&E. The last change that I want to take you through is on disclosure of repairs and maintenance. Now, you would know this isn't ordinarily a disclosure that's in the financial statements. There isn't any particular requirement to disclose repairs and maintenance, nor do we have any guidance in the standards about how to calculate it. Now, obviously, we don't have disclosure of repairs and maintenance because it doesn't really fit into the current classification function of expenses on the Statement of Financial Performance. We would generally classify expenses either by nature or by function. Repairs and maintenance inherently is a whole lot of different goods and services that you would have purchased. So typically you wouldn't see a repairs and maintenance line item on the Statement of Financial Performance up until now. We know that users are very interested in how much is spent on repairing and maintaining and refurbishing assets. So users say to us, well, this is the type of information that they really need. Quite often that they would want to do is understand the metrics between the asset base and obviously the amount that's actually being spent to repair and maintain those on an annual basis, and there's some norms and standards that have been put out by the Treasury. But obviously without that information, specifically in the financial statements, it's very hard for them to actually make those correlations. So we have amended the requirements in GRAP 17 to specifically ask that you disclose repairs and maintenance in the notes to the financial statements. We haven't been prescriptive about how you calculate repairs and maintenance. All that we've asked for is that you actually describe exactly how you go about calculating repairs and maintenance. So, for example, does it include your own internal works department, goods and services that you've purchased, overheads that you may allocate, etc. Quite importantly, we've made the same change for investment property because, again, I think if you have these properties, it's important for users to understand how much you are spending to repair and maintain them, and likewise on heritage assets. So you're required to disclose repairs and maintenance for those 3 asset types in the notes to the financial statements. Now, probably 2 important things just to touch on before we finish up in terms of the amendments that we made to GRAP 16 and GRAP 17. 2 things we always get asked, okay, so what are the transitional provisions for these changes? Do I need to go back and either adjust and restate my financial statements, or do I just apply the new requirements going forward? So it's a bit different. They're all different for the different requirements. So the first one is on disclosure of repairs and maintenance on assets. We decided to make this prospective just because during the consultation with preparers, they indicated to us that they would not necessarily have all the information available to do this. There might be some reforms at the moment that might actually help support this disclosure, like the MSGO reforms on a municipal side, but obviously the PFMA entities might not necessarily have all the information in exactly the same way. The indicator-based approach to the assessment of useful lives and residual values, we've also said apply this prospectively. And obviously, if we want you to assess indicators at a moment in time, it's very hard for us to say that you actually need to go back and assess the same sort of indicators at a previous reporting date, because that would actually require hindsight. So just apply that prospectively. The disclosure on capital work in progress, again, when I explained some of the amendments that we were proposing, preparers had indicated that they might not have all the information available. So again, as a way of ensuring that entities are able to comply with the requirements, we've said that this should just be applied prospectively. So there won't be any comparative information in the first year this is applied. The use of external valuers, and remember we said that you can now use an external valuer or an internal person that's competent to perform these valuations, just apply that prospectively. It's obviously very hard to go back, and not that you would want to anyway, is to get somebody else to do your valuations. So again, it's just to apply going forward. In terms of the classification of investment property and property, plant and equipment, as I mentioned up front, we didn't really change any of the classification principles. We actually just tried to clarify some of the existing requirements. So again, because it's just a clarification of principle, we want you to apply this retrospectively, and this would mean that you would need to go back and reclassify and restate any investment properties that don't meet the new requirements. The last one is the deletion of all the encouraged disclosures. If you did provide any information as part of your encouraged disclosure requirements in previous reporting periods, you would just need to go back and adjust those. So it's a retrospective restatement of your financial statements. Then lastly, just to recap again, the effective date for these amendments, it's for financial years commencing on or after 1 April 2016. So that means for PFMA entities, 31 March 27 is the compliance date, and for local government, it will be 30 June 2017. Thank you.